property prices took 14 years to recover to their original value. Hey guys, welcome back to Financial Freedom Through Real Estate Course, FFRE, or Free Course for short. In the previous video, we introduced the concept of financial freedom and cash flow, and we shared about how we came from humble beginnings and average salary employees towards achieving financial freedom by buying US cash flowing rental properties. Let's dive into core investing principle number 1, which is to invest in cash flow and to avoid money pits. Investing in money pits keeps you poor. It makes you require to work hard until you get rid of such liabilities. Well, you may be wondering, hey, this kind of thing so obvious. Why do you need to tell me? But you may be surprised that there are many people out there around you that you may even know of. They are throwing money into money pits. But we want to note that whatever examples that we are showing you, they are by no means bad investments. It's just what strategy or what objective the person is working towards. We are simply presenting the facts, and you can decide yourself whether this kind of investment suits your objective of retiring early. But the intent of this course and our investment goal is for financial freedom, meaning we need the cash flow coming in to be able to fund our daily expenses. Can you retire early with negative cash flowing or negative gearing properties? I believe most of you will answer no. Why? Because you will need your own income to continuously feed this property because it is negative cash flow. But people still buy it because, why? They are hoping for appreciation. Now, let's think about a few questions. Is appreciation always as advertised? If you want to sell your property in 5 years' time, do you just buy and hope that it appreciates sufficiently? What is your target appreciation number? Do your math. A healthy and strong economy will typically appreciate at about 3 to 5% per annum. So do your math and don't hope that somehow your property appreciates at 10% every year, as that's just not realistic. Lastly, is buying only for appreciation with negative cash flow risky? Friends, hope is not a plan. Don't buy money pit and hope that it will be able to appreciate enough to fund your retirement. And don't forget to compensate all the negative cash flow or the mortgages that you have to pay over the many years. Let's take a look at some of the property price trends in various countries. This is the Singapore Property Price Index over the past 30 years. In the long run, property prices will generally appreciate due to inflation because of increased cost of labor and materials to build. This chart shows that Singapore property price have cycles of up and down, but on average they appreciate at about 4.6% annually over the past 30 years. But let's take a look at the downs. The first dip was during the recession in 1981, and property prices took 10 years to recover to their original value. The second dip in 1996 was due to the Asian financial crisis. In this case, property prices took 14 years to recover to their original value. And lastly, in 2013, due to oversupply, property prices dipped again and took 7 years to recover to their original value. So if you hold on to a negative cash flowing property and hope to sell after 10 years of annual appreciation, what if you bought just before dip? You can see from real historical data, dips can last 10 to 14 years. After 10 years, your property could have appreciated by 0%. Now this begs the question, where are the property prices going? Are they going up or down? Nobody knows. I also don't know. So back to the question, is buying only for appreciation risky? How long do you have to wait for meaningful appreciation? And while having negative cash flow all this while. And every day you hope that the price doesn't dip. Is that a smart investment? Is that worth the wait? And it's not just only Singapore. Any country will experience recessions, and therefore there will be cycles of up and down, appreciation and some low valley period where you have to wait a long time to see appreciation. Take a look at these very typical examples of a condominium in the bustling cities like Singapore, London, or New York City. The first photo shows a London condo going from 730k pounds, which is about US $935,000 for one bedroom studio unit. While the second photo shows a Singapore condo, one bedroom unit costs about 1.1 million, which is about US $815,000 US. So these are very similar in terms of numbers and very representative of typical condo prices in bustling cities like London and Singapore. Assuming a typical 20% down payment and taking a loan for the remaining 80% of the cost. This equates to a monthly mortgage payment of about $3,000 for both properties in their currencies. But if you check the rents in the area for a one-bedroom unit, it is only about $3,000 per month, again in their respective currencies. So what is your monthly cash flow? It is negative. The rent is not enough to pay for the mortgage, and we haven't even counted in operating expenses like property taxes, insurance, management fee, condo fees, repair buffers, and so on. Because of the high purchase price to rent ratio, rent is not enough to cover the mortgage and operating expenses. That is why you end up with negative cash flow, or some says negative gearing. All right. Will negative cash flow give you passive income to retire early? No. You must continue to work to earn income to pay and service these properties. Now, let's go back to principle number 1. How many of you know people out there that buy negative cash flowing properties like the examples that I've shown you? I'm sure there's a lot, right? In fact, this is the most common properties that people in our country buy for investment, which are negative cash flowing. Again, we are not saying that these are bad investments, but the question is if it is aligned to what you are going for. Financial freedom, retire early, right? Does a negative cash flowing property that takes money out from your pocket every single month, which makes you have to work longer and harder every single day, gets you to financial freedom and retire early? That is the question. If you hold on to a negative cash flowing properties while waiting for appreciation, does this generate passive income for you so that you can retire early? No, right? And even after you sell the property, let's say you have a lump sum of $500,000, can you retire early living off that amount? Let's say average Singaporean spends about $60,000 a year on their own living expenses. This 500k would easily be used up in 8 years. And that does not account for inflation over the long run. So the point here is to collect assets that continue to generate income for you every month as long as you own them. Even if you are 60, 70, 80, 90 or even 100 years old. For the rest of their life to pay for your living expenses. The goal is to have passive income replace your earned income so that this passive income will fund your lifestyle so that you don't need to have a job. Now there's another type of investor which you probably also will know about where they find it very, very expensive to invest in properties in their own country. So they look elsewhere, nearby, overseas to find more affordable option. Now take a look at this example, a real life example. I have an ex-colleague that bought another condo development in a nearby country. The reason why he did it was because it was cheap, it was affordable, and he wanted it to be a holiday home or a potential retirement home. After investing in it, it was negative cash flowing. It was negative rent income. And after several years, the property slowly lost value. And over many years, there was huge forex loss. So now the property is stuck in limbo. It doesn't make sense to hold, but you make a huge loss when you sell. So the question is, why did these properties that are cheap and affordable not make money? Now let's take a look at another example. Almost a decade ago, our neighbors had a great plan to grow the region. There were mega projects, mega developments that brought in schools, industry, factories, jobs. But after 10 years, CNA recently reported that the occupancy remained low in some of the housing development. Why? Because the price and the rental range is not suitable for the locals. Same here in this example. Look at the 3-bedroom houses at 15 million pesos, which is about 360,000 Singapore dollars. But note that their local average income is only 300,000 pesos. The property is 50 times the annual income. How can an average household afford such high-priced properties? You're looking at the super rich people that can afford such properties. But then think about it again. When you want to rent to and sell to, who is your target audience? Would you want to only rent and sell to the very limited and very affluent class, or would you want to rent to the normal day average people where you have the most number of population? Think about it. So buying what you think is affordable might not be the smartest investment decision. Buying what the locals find affordable is smart investing. Now let me show you another famous listed company that is also selling a 3-bedroom in Cambodia at about 240,000 US dollars. When the local monthly household income is only about $479 per month. When you buy such properties, who are you really selling to? Who are you going to rent to? Who can afford that kind of rent to make sense for your numbers. These properties clearly is out of reach for the locals. And this is how people get stuck when they buy overseas property investments, because they do not know the price point, the price range of what the locals can afford and can rent. They buy thinking that it is cheaper compared to their home country, not cheaper compared to what the locals can afford.
Okay.
And therefore, this is when cheap properties also become money pits. Now take a look at the property that we bought in US. We got it for $90,000 in 2021, which we bought with a loan of $7,000. When we first got it, we were renting it out for $900 plus, generating about $300 of passive income a month. Does the property price of $90,000 and a rent of $900 plus for the entire house look affordable for you? Now today, the rent is $1,421. and the passive income is $783 per month. Consider that their median family income is $88,000. Even if the rent goes up to a gaudy $2,000, does it look expensive? If you invest in such property, do you think you will have challenges renting it out and selling it easily? Another thing to point out, typically the properties that we find in US are usually below $200,000. Now take a look at this example. The property costs $178,000 while a nearby property rents for $1,700. Now compare with a one-bedroom condo in Singapore that costs $1 million and rents for $3,000. Now ask yourself, how many $200,000 properties in the US can you buy to match the 3K rent income that you get from a one-bedroom Singapore condo? Think about it. Two, right? You just need two $200,000 property. But think about it, how much cost do you have to put in to get this $3,000 in Singapore or in US? It's no brainer. Therefore, you have to always consider price to rent ratio and choose the right market that meets your desired yield. So to summarize, principle number one is to buy cash flow and avoid money pits. Avoid buying stuff that keeps you poor. Always run your numbers. Make sure that it cash flows. Make sure that what you buy is what the locals find affordable, not what you find affordable. In the next video, we will review principle number two, cash flow or appreciation. Thank you for your time, and I'll see you in the next one. See ya.